Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. I'm sure you've noticed that there are star performers in every bull market. When it comes to the current bull market, one of the star performers undoubtedly has been the Tata Group company, Tata Elxsi. From its bottom in March 2020 to the top in August 2022, the stock has been a whopping 20-bagger and looks all set to climb even higher in the coming years. Investors who bought the stock somewhere near its lows back in 2020 and have held on to it since are no doubt sitting on some huge gains. And if they had managed to invest even rupees 6 to 7 lakhs back then, Tata Elxsi alone would have turned them into a crorepati. Put differently, Tata Elxsi can well be called a true blue crorepati stock. Now, of course, there are a lot of investors who missed out investing in the stock back in 2020, and they are wondering, since the stock has a great future, does it make sense to invest in the stock right now? Of course, the gains may not come as fast as they have come in the last 2 years, but can Tata Elxsi still be a market-beating stock going forward? Also, those who invested in the stock 2 years back and are sitting on some strong gains, what exactly are they supposed to do now? Should they hold on to their gains or should they book total profits while the stock is still close to its all-time high? Well, answering these crucial questions is my purpose behind making this video, and what I'm going to do is I'm not going to give you a straight yes or no answer. Instead, I'm going to walk you through a couple of case studies by the end of which you should hopefully have answers to all your questions around Tata Elxsi. So here's the first of the two case studies, and it concerns none other than Warren Buffett. A few months ago, I came across an interesting post on Twitter. We all know that one of Warren Buffett's most successful investments is the soft drink giant Coca-Cola. It is said that Coca-Cola's stock price increased from US $2.4 per share in July 88 to US $43 per share in July 98. This is a huge 18x in 10 years. The stock was effectively an 18-bagger, multiplying Warren Buffett's original investment by a massive 18 times. Now here comes the interesting point. In the last 22 years, the stock price has moved up only 40% to US $60. Yes, you heard that right. A stock which went up by 18x in 10 years delivered a return of only 40%, 4040 over 22 long years. This tweet that highlighted these data points about Coca-Cola then went on to conclude that almost none of the stocks should be held forever. In other words, almost no stock should be held forever, and almost every stock should be sold after a suitable holding period. But is this the right conclusion to draw from the study? Perhaps yes, for someone who would have bought Coca-Cola back in 1998 after the huge 18x jump in the stock price. But what about Buffett? Is this simple takeaway that almost no stock should be held forever applicable to Warren Buffett also? Well, I don't think so. I don't think it is this simple. Let me tell you why. You see, Warren Buffett is still invested in the stock. So he bought Coca-Cola in 1988 and has held on to it for 32 years if you consider 2020 as the end date. Now, back in July 88, when Buffett bought Coca-Cola first, the US benchmark index S&P 500 was around 270 levels. Right now, it is at around 4,000 levels. This translates into a gain of almost 15x. How has Coca-Cola or Coke done during the same period? July 88, the share price was around US $2.7. Right now, it is $61.2 per share. This translates into a gain of 22.7x. So on a price performance basis, Coke has outperformed the benchmark index. Now please don't forget the dividends and buybacks that Coke must have done during this period. The smart investor that Buffett is, he must have certainly put dividends received from Coke to good use. Therefore, Coke has proven to be a tremendous buy for Warren Buffett. Now, the difference between why Warren Buffett made money on Coca-Cola and the investor who may have invested in 1998 and earned only 40% returns over 22 years is price to earnings multiple, or the PE ratio as it is popularly known. It is estimated that Warren Buffett bought shares of Coca-Cola. He paid a price to earnings multiple of around 15x on an average. However, the investor who would have bought 10 years later had to pay a PE multiple of close to 60x. Yes, that's correct. Warren Buffett paid 15x. The investor who bought in 1998 paid 60x. Coca-Cola became 4 times as expensive in 1998 than it was in 1988 when Buffett bought it. And this is one of the key reasons why it turned out to be such a poor performer between 1998 and 2020. So this clearly shows that even if you buy a quality stock like Coca-Cola, make sure that you do not pay a very high PE ratio. However, this does not apply in the case of our second case study, the case study of Infosys Limited. Infosys was trading at a PE of a huge 132 back in December 2000. Any value investor in his right mind would have avoided investing in the company shares where the PE was so high. However, like Coca-Cola, Infosys is not up just 40% between December 20 and December 2020. December 2000 and December 2020. In fact, even at a PE of 132x, Infosys is an impressive 14-bagger between December 2000 and December 2020. A very high PE of 132x has not stopped investor from making good returns from the stock over a 20-year period. So now you have a very interesting situation. 2 case studies with 2 different outcomes. In the case of Coca-Cola, paying a high PE ratio was one of the main reasons why Coca-Cola was up just 40% over 2 decades. But in the case of Infosys, paying an even higher PE of 132x did not prevent investor from earning 14x returns over a similar time period of 20 years. Now please note that as I record this video, Tata Elxsi is trading at a PE multiple of almost 90x its trailing 12-month earnings. This means that it is more expensive than Coke's valuation in 1998 and cheaper than Infosys valuation in December 2000. So what do you think Tata Elxsi will be, say, 20 years from now? Will it be sitting pretty like Infosys with 14x returns, or will it be a massive underperformer like Coke? In other words, is Tata Elxsi a good stock and a good investment like how Infosys was back in December 2000, or is it a good stock but a bad investment like Coke? A good stock is a high quality company like how both Infosys and Coca-Cola are. However, a good investment is an investment with good returns like how Infosys was back in December 2000, but Coke was not back in 1998, as it gave just 40% returns over the next couple of decades. Coke was a good investment between 1988 and 1998 when it was up a huge 18x. Well, Tata Elxsi is a good stock, no doubt, but whether it will prove to be a good investment a couple of decades down the line depends on another important factor: the rate at which it is able to grow its earnings going forward, that is the earnings growth rate. Now, the reason Coca-Cola was such a poor performer was because its earnings grew at only 5% per annum between 1998 and 2022. From a high of around 15% CAGR for the decade prior, the growth crashed to just 5%, which is why the PE multiple of 60 that it commanded in 1998 also came crashing down to around 20 to 22 times, and this led to the massive underperformance. Well, the PE ratio of Infosys also crashed from 132 to just 30x between 2000 and 2020. But it was still able to multiply shareholder wealth by 14x because of the massive growth in earnings. The earnings of Infosys improved by a massive 62 times between December 2000 and December 2020. It was this 60-fold jump in earnings that allowed Infosys shareholders to grow their wealth by 14x despite paying a very high PE multiple of 132x. Therefore, the road to making good money in Tata Elxsi from the current levels is quite clear. For anyone investing now, Tata Elxsi will have to continue to grow its earnings at a very fast pace going forward, perhaps at the same rate of Infosys or even more. Now, those who had invested in Tata Elxsi back in 2020, for them the choice is quite clear. Back in 2020, when the markets crashed, Tata Elxsi was trading at a PE of between 15 to 20x, around the same valuation that Coke was trading at when Warren Buffett bought the company. Now, the reason Buffett still ended up making money despite Coke's poor performance between 1998 and 2020 is because he did not pay a very high PE multiple while buying. He paid a very reasonable 15x multiple, and this allowed him to earn market-beating returns despite poor earnings growth of Coke after 10 years. Therefore, I think that for those who bought Tata Elxsi back in 2020 at a PE multiple of 15 to 20x or even slightly higher, they have to only ensure that Tata Elxsi will still be around 20 years from now. Even if it grows at a much smaller rate of 5% to 10%, they will still end up making good money in the stock if they continue to hold on to it. But for those who paid a very high PE multiple to buy the stock, for them it is very important that the company continues to grow its earnings at a very high rate. Infosys grew its earnings at a whopping 22% between December 2000 and December 2020. Growing at 22% for 20 years is no mean feat. Only the rarest of rare companies is able to achieve this. And despite this, Infosys was able to beat the index only marginally during these 2 decades. A 62 times growth in earnings led to only 14x growth in share price because of the high PE multiple paid at the start of the investment journey. You see, in investment, it always pays to be conservative. Besides, odds of any company growing at 20 to 25% per year for 20 years is very much on the lower side, which is why those wanting to invest in Tata Elxsi need to consider these 2 factors very seriously. On a conservative basis, how much is a company capable of growing over the next 18 to 20 years? Even the best of the best struggle to grow at 20% to 25% for such a long period of time. Is Tata Elxsi the exception to this norm? Another way of looking at this is taking into account the upside as well as downside scenarios. What is the upside if you buy at these levels and the stock manages to grow earnings like Infosys? Well, as far as Infosys is concerned, even with a very high growth in earnings, it could beat the benchmark index by only a small margin. What is the downside if the earnings go the way of Coca-Cola? Well, it could be huge if earnings follow the pattern of Coca-Cola. In investing, the future is always uncertain, but the real gains go to those investors who always try to minimize the downside and maximize their upside. I guess you need to keep all of these factors in mind while deciding to invest in Tata Elxsi at these levels. Please share your feedback in the comment section, and please do like the video if you found it useful. I'll see you again next time. Goodbye and take care.